A banker once bragged that a single note from his desk could buy an entire neighborhood. Months later, that same note couldn't buy a loaf of bread. Crowds stormed the streets, not to protest a leader or a war, but to protest the collapse of something invisible value itself. Families who thought they were wealthy woke up poor. Governments that believed they could control the crisis realized they had accidentally accelerated it. And in the middle of the chaos stood one haunting question: what happens when money dies? The story doesn't begin with chaos. It begins with confidence, almost too much of it. After World War I, Germany, like many nations, believed it could rebuild its economy simply by printing its way to stability. Politicians insisted inflation was temporary. Bankers believed markets would correct themselves. Ordinary citizens trusted that the bills in their pockets still meant something. But beneath that surface ran a deeper fracture, one that had been growing for years, a mismatch between the money people used and the real value backing it. The twist came later, but the seeds were already buried in policy speeches, emergency decrees, and quiet decisions made behind closed doors. The new era of paper money seemed harmless because it felt convenient. Gold no longer had to move from vault to vault. Numbers could shift on ledgers. Governments could respond faster to crises, but every shortcut comes with a cost. In Germany's case, that cost began with war reparations the country couldn't realistically pay. The government printed money to cover expenses, believing it could reverse course once the crisis eased. But crises rarely behave. Early signs of trouble appeared as prices ticked upward slowly at first. A loaf of bread rose from half a mark to a full mark. Rent climbed. Wages lagged behind. Still, officials claimed the increases were manageable. They argued that a little inflation kept the economy moving. Meanwhile, foreign investors noticed cracks. They began selling German marks, pushing the currency down. That decline forced the government to print even more money just to keep up with obligations. And so the cycle tightened like a noose. There was no single moment when people realized the system was failing. It happened through a series of subtle shocks. A butcher raised prices twice in 1 week. A factory owner paid workers twice a day because wages lost value between morning and evening. Housewives rushed to markets the moment they were paid because waiting even an hour meant groceries became unaffordable. The currency printed to stabilize lives was now destabilizing them. By the time Germany hit the breaking point in late 1923, the numbers no longer made sense. Banknotes had denominations so large that the ink cost more than the value printed. Workers carried wages home in wheelbarrows. Children used bundles of bills as building blocks. Restaurants refused to list prices because they changed too quickly to be written down. Money had lost its function, not just as a store of value, but as a form of trust. And when trust dies, money dies. At the height of hyperinflation, the mark collapsed to the point that a single US dollar was worth trillions of German marks. Entire lifetime savings evaporated. The middle class, the backbone of any stable society, was financially shattered. People who had done everything right were suddenly ruined through no fault of their own. They didn't gamble, they didn't invest in risky schemes. They simply held money, and the money betrayed them. The fallout looked nothing like the typical financial crisis. When a stock market crashes, people lose investments. When money crashes, people lose reality. Stores stopped accepting currency. Workers demanded payment in goods. Farmers withheld food until they could trade directly for necessities, bypassing money entirely. Bartering returned, not because people preferred it, but because the monetary system had stopped performing its most fundamental job. Governments then rushed to apply fixes, most of them failures. They introduced wage controls, price controls, new regulations, and emergency laws. Nothing worked because none of these measures addressed the root issue: confidence. Once citizens stopped believing in the currency, policy tweaks were powerless. The government tried printing higher value notes to keep up with inflation, not realizing that each new bill deepened the problem. The economy was drowning, and every attempted rescue poured more water into the ship. Only when the government created a completely new currency, one limited in supply and backed by real assets, did stability return. The old money became worthless overnight. A new monetary order replaced it, but the psychological damage endured. A generation scarred by the collapse of currency became deeply distrustful of inflation, financial policy, and political promises. The memory shaped national behavior for decades. This pattern is not unique to Germany. it has appeared repeatedly across the world. In Hungary after World War II, in Yugoslavia in the 1990s, in Zimbabwe, in the 2000s, in Venezuela more recently, and in smaller pockets of economic turmoil where currencies spiraled out of control. The specifics differ, but the underlying mechanism is strikingly similar: governments facing pressure print more money than the real economy can support. The twist in our era is more subtle and more global. Today, countries don't need printing presses. Money creation happens digitally through central banks, debt markets, and financial instruments. Trillions can be created with a few keystrokes. During global crises, governments inject massive liquidity to prevent recessions. And while those actions often prevent immediate disaster, they also expand money supply faster than economic output, echoing the same imbalance that fueled past collapses. This raises uncomfortable modern parallels. In the United States, the money supply expanded by trillions within months during pandemic relief efforts. In multiple countries, debt levels exceed historical records. Inflation surged worldwide at rates unseen in decades. While this is nowhere near hyperinflation, the underlying pattern: excess money chasing limited goods remains an economic law with no exceptions. The warning signs of monetary stress often start quietly. Rising asset prices disconnected from wage growth. Governments accumulating debt faster than they can realistically repay. Central banks delaying difficult decisions because the short-term pain seems politically impossible. Confidence eroding not dramatically, but gradually, through small shocks that seem isolated until they align. Another repeating pattern is the belief that this time is different. In every historical case, leaders insisted they could manage inflation through intelligence, strategy, or technology. And in every case, confidence was lost faster than it could be rebuilt. Monetary systems are fragile not because of math, but because of psychology. The numbers matter, but the trust behind those numbers matters more. As modern economies grow more interconnected, the stakes grow higher. A currency collapse in one nation used to stay contained. Today, it can send shockwaves across markets, supply chains, and digital assets within hours. Financial systems are more sophisticated, but also more sensitive. The world has never created so much money so quickly, and never relied so heavily on the assumption that trust will always hold. History suggests otherwise. When money dies, it rarely announces its death. It weakens quietly. It slips in value slowly. It corrodes purchasing power, household savings, and long-term plans. At first, people adapt. They pay a little more for groceries, take on more debt, delay major purchases. But eventually, adaptation becomes strain. Strain becomes resentment, and resentment becomes instability. And by the time the collapse is visible, it's already too late to prevent. The most difficult lesson is that money doesn't need to disappear physically to die. It can remain everywhere in circulation, yet worth almost nothing. It can fill wallets, bank accounts, and digital screens while failing to do the one thing money is supposed to do: preserve value. Still, history also shows what prevents collapse: strong institutions, fiscal restraint, transparent communication, monetary discipline, a willingness to address small problems before they become unmanageable. When these fail, currency follows. Modern societies often assume collapse can't happen again, especially in developed nations. But the financial system operates not on guarantees, but on probabilities, and the probability of monetary dysfunction increases when inflation runs hot, debt climbs uncontrollably, or governments use money creation as a shortcut for economic growth. The real danger, isn't hyperinflation, is losing the ability to reverse course before reaching that point. Every major currency collapse began with warnings dismissed as exaggerated, temporary, or politically inconvenient. So the question isn't could it happen again, the question is how close must we get before we pay attention. 3 takeaways stand out. First, currencies don't collapse because of a single mistake. They collapse when many small mistakes accumulate and break public trust. Vigilance matters more than optimism. Second, inflation is not simply a rise in prices. It's a signal of imbalance. When money grows faster than real production, pressure builds, and history shows that pressure eventually demands release. Third, monetary systems survive only as long as people believe they will. Confidence is not a soft factor. It is the foundation when trust erodes. No policy, no matter how clever, can save a currency already in freefall. If history teaches anything, it's that societies rarely recognize the moment just before money dies. They only recognize the aftermath. If this story challenged your view of money, economics, or the fragility of financial systems, consider subscribing for more deep dives. And stay curious, because the next major shift in global finance might already be unfolding. Quietly beneath the surface,